Hey guys, this is Aditya and welcome back to Capitalmind. So let's have the disclosure before we start the video. None of the stuffs that I'm going to talk about in today's video should be taken as investment advice, and clients of Capitalmind may maintain positions in the securities that I might discuss in today's video. So today we'll be talking about the sovereign gold bond scheme, and this is going to be the last video under the Bond Baba series. We do a lot of interesting stuffs at Capitalmind. At Capitalmind Premium, we offer free and premium articles, portfolio strategies, and we also have a very vibrant community of traders and investors on our Slack channel. At Capitalmind Wealth, we offer PMS services, and we also do Capitalmind podcast where we talk about a lot of things: markets, economies, products, general discussion. So make sure you follow us on Twitter. Make sure you subscribe to our YouTube channel so that you get the content whenever we release it. So let's get back to today's discussion. So we are talking about the sovereign gold bond scheme. So before we start, I would like to give you some information. So India is the second largest consumer of gold in the world. So we held the first position for a very long time, but then we were eventually overtaken by China. So currently China is the largest consumer of gold, followed by India. So let us look at the price performance of gold over past 2 decades. See, this blue line denotes the price of gold from April 1990 onwards, okay? And this gray line is actually 5-year rolling returns. So when you look at this graph, 2 questions should come into your mind. The first one is, what are rolling returns and why are we taking 5-year rolling returns rather than 1 year, 2 year? Why not 1, 2, 3 years? Why 5 year? So let me answer the first question. What are rolling returns? See, first, you need to understand how are rolling returns calculated. So suppose today is 30th December 2019, and if I want to calculate the rolling return from today, then I will compare the price of gold on 30th December 2019, that is today, with the price of gold on 30th December 2018. And if I'm calculating from 1st, 2nd, 3rd, 4th, 5th of January, then the price of gold on 1st January 2019 will be compared with the price of gold on 1st January 2018. 2nd January 2019 will be compared with 2nd January 2018. 3rd January 2019 will be compared with 3rd January 2018. So every date will be compared to the same date previous year. Why do we do that? See, this gives a more accurate picture rather than taking a periodic return, say from 1st January to 31st December. This is just a periodic return, right? 12 months. If you take rolling returns, calculate the returns for every day compared to year over year, the same date, it gives you a more accurate picture. It shows the behavioral profile of the return. Now, the second question is, why 5 year? Why not 1, 2, 3 years? I'll answer this question eventually. Once we move deeper into the discussion, I'll answer this question. Why are we taking 5-year rolling return? So let's come back to the chart. If you see the rolling returns, the returns are pretty handsome till 2013. See the rise. It's very good, right? But from 2013 onwards, the returns have not been so good. Rather, they have been bad. Why? Because one reason is like from 2013, we had import duties and that impacted the demand and all that. But here, if you see, there is a trend. So things are improving for the better. And a lot of people are showing interest in this commodity, in gold, what we call as a precious metal. So let's discuss, since a lot of people are showing interest in gold, what are few instruments where the underlying asset is purely gold. So I want to know what are my options if I want to buy gold today. Say the very first option is just buy physical gold, but that's not a very prudent way of investing in gold. That's not a very efficient way of doing that. Then I would like to know what are the other instruments where the underlying asset is purely gold. So let us have a look. Let me go back. See, as I said, one way is to just buy physical gold. The other way could be just buy a gold ETF. Gold Bees is a good example. So when we talk about gold bees, they actually buy physical gold. So when you invest in gold bees ETF, they go and buy gold and they store it in lockers, keep it safe, and they charge you a pretty high expense ratio of 0.8 to 1%, which definitely will impact their returns because of the higher expense ratio. So that becomes a limitation of gold ETFs, which purely have underlying asset as gold. And the other option could be sovereign gold bond. This is a fairly new instrument. It was launched around 2015. So here the funda is very simple. You buy gold from the government without actually taking the possession of physical gold. So there is no physical gold involved here. You just buy the bond from the government. On maturity, they will give you the price of gold. So if you invest today and suppose the bond will mature after 8 years, after 8 years, they will return your money, in comparison with the per unit, per gram price of gold. And you can take the money and you can just buy physical gold from the market. So that is how it works. Of course, we are going to look in much more detail. So let us try to understand the sovereign gold bond in a little bit more detail. See, sovereign gold bond behaves exactly like gold. So if the price of gold goes up, the value of the sovereign gold bond goes up. And if the price of gold goes down, the value of your sovereign gold bond goes down. And second thing, it's issued by the RBI in the multiples of 1 gram of gold value. And this is where the story gets really exciting. The government gives you an interest of 2.5% every year, semi-annually, on top of the price of gold. So whatever be the price of gold, the government will pay you 2.5% extra every year. Now this is like a guaranteed return of 2.5% on and above the price of gold. And most importantly, you should understand that in this case, there is no actual gold backing. Like compared to gold bees, when you give your money to gold bees ETF, they go and buy real gold, physical gold, and they keep it in locker. But that's not the case with sovereign gold bond. The government doesn't buy gold with your money. So you should know this, that there is no gold backing. Now let us look at a couple of more points. Why is the government doing this? Like, what is the rationale behind launching the sovereign gold bond scheme? What is the incentive for the government here? See, even if you don't know much of the economics, you should know this. If a country's exports are more than its import, the country's GDP goes up, the country's GDP grows. If your exports are more than imports, this is a very basic way of understanding how things work in the economy. But for this discussion, this will work. But with us, what has been happening is we have a huge dependency on gold. So if a country's imports are more than its exports, then the GDP will not grow, right? So we want the ideal situation where our exports are higher than our imports. But because of our huge dependency on gold, our imports are always higher than our exports. In fact, if you go back and check the export and import numbers for the March quarter of 2019, you will see that if you just take out just one component from the imports, which was gold import, India was a net exporter. So just because of gold, we were a net importer, and obviously the government doesn't want that. The government wants the economy to grow, and that is why it wants us to move away. It wants retail investors, people like you and me, to move away from physical gold, and that is why the government is actually giving you 2.5% more on the price of gold, and the government is saying, please don't buy gold. I will give you 2.5% on top of gold returns, but please don't buy gold. So now we understood the incentive for the government to do this. But is there any incentive for retailers to go for a sovereign gold bond rather than going for physical gold? What is in there for me? See, there are a lot of benefits. First of all, safety and storage is not a concern. When you buy physical gold, you have to make sure that you keep it in a locker. There is always chances of theft. And if you don't keep it at your home, you have to buy a locker in a bank and pay for it and keep it in a bank. But that's not the case here because there is no involvement of physical gold. So that is completely ruled out. Second, no wastage and purity issues. See, generally we talk about two types of gold, 22 karat and 24 karat. So 22 karat is used for jewelry making, and 24 karat is very, very close to 100% purity. If a gold is 100% pure, it's difficult to make jewelry out of it. So that we need some impurities to make jewelry. That is why for jewelry making, 22 karat is used, and for storage purposes we use gold bars which are 24 karat, which is closer to 100% purity. Now in gold bond scheme, the government on maturity will pay you the price of the 999 quality gold, which is 24 karat. So this gold bond scheme deals with the purest form of gold available in the market, which is 24 karat or 999 quality gold. Now the third point is you get interest as well, as I explained it. So suppose your father bought gold 30 years ago, and in 30 years the gold price has fairly compounded, like it has given decent returns. But had it been the gold bond scheme, you would have earned 2.5% on top of it every year for 30 years. Imagine your returns. It would have been really handsome, right? Much better than the returns from your physical gold. And then there is no risk of default because it's the government. Generally, governments don't default. There have been extreme cases such as Venezuela, but our government is in a much more comfortable position. So there is no risk of default as such. And then loans without valuation charges. This is really important. So most of the time when you pledge your gold and you take a loan, the bank will charge you something called as valuation charges. So the bank will actually value your gold, because if you give something and say that this is valued 2 lakhs and you give me a loan worth 1.5 lakhs. Now the bank needs to check, right, whether your gold is actually valued at 2 lakhs or not. So they do some valuation and all that stuff, and they charge you for that. But if you own a sovereign gold bond, you can just pledge the papers and take loan. There will be no valuation charges, obviously, because there is no physical gold involved. And then there is no question of spread at all, because most of the time when you buy gold and you try to sell it after say 2-3 years, and if you go to some other vendor, suppose you bought it from a jewelry shop and now jewelry shop A, and now you're selling it to jewelry shop B. So they will definitely deduct 2, 3, 4%, depends on the purity of gold. And that loss is always there. So if you earn 10%, say over 3, 4 or 5 years, and then if the shop owner deducts say 3%, he cuts 3% value from your gold, then you lose 3%, right? Then your net return is just 7%. But that's not the case with sovereign gold bond. So you get the purest form of gold available, and there is no question of physical gold involved. It's just paper. So there is no question of spread. So let us look at some other points. So as I said, the interest payable is 2.5%, and you receive it twice a year, semi-annually, and the maturity is 8 years. So there is a lock-in period of 5 years, although it's tradable on exchanges, but you can't redeem it before 5 years. The lock-in period is of 5 years, and after 5 years you can redeem it after every 6 months. So whenever you get the interest payment, in every 6 months you get interest payments, at that time you can redeem it. Now coming to who can buy sovereign gold bonds, except NRIs and companies, anyone can buy. As simple as that. And coming to the taxation part, see, if you hold this bond to maturity, there is no capital gains tax. It's exempt. And obviously interest income will be taxed. It will be taxed according to your slab rate. That's it. So we looked at the sovereign gold bond scheme in fairly detail. Now let us go back to ETFs. Like we understood sovereign gold bond and we understood ETF, but should we consider ETFs as well? What has been the return profile of gold Bs compared to the physical gold? Let's have a look. See, gold Bs was introduced in 2007, and let us have a look at the return profile since then. See, from March 2007, this orange line actually denotes the gold Bs performance, and the blue one is the price of actual gold. So if you see, it has always underperformed the actual gold. So what is the point of buying an ETF? And it is very obvious why it's underperforming, because of the expense ratio. They charge you around 0.8 to 1%. So as you can see, it has always underperformed the price of the returns by gold. Now if you see the 12 years CAGR, actual gold has given you a return of 12.43%, where gold Bs has given you a return of 11.18%. It's a significant underperformance. So we looked at gold Bs, which is gold ETF. We looked at the sovereign gold bond scheme. Now let us try to compare everything. Let's bring everything in one chart and decide which is the best one for us. Like Should we go for physical gold? Should we go for gold ETF? Or should we go for sovereign gold bond scheme? So right now on your screen you have the physical gold, gold bees ETF and the sovereign gold bond. So we want to compare the return profile of all the three physical gold, gold bees ETF and sovereign gold bond. We want to plot them on a chart, on a graph, and we want to see which has delivered the maximum return, and then we want to take a call. But then there's a small problem here. What is the problem? See, the sovereign gold bond was launched only in 2015, right? It wasn't there prior to 2015. So how can you compare something which was launched in 2015 with an ETF which has been there since 2007 and physical gold where the data is available from decades ago? So how to do it? It's very simple. So what we'll do is we will calculate synthetic returns for sovereign gold bond. So how will we do it? It's very simple. See, what does sovereign gold bond offers you? It offers you first and foremost, it offers you returns of gold. So if gold returned say 10%, sovereign gold bond will definitely give you 10%, and on top of that it will give you an interest of 2.5%, right? So just add them up and take the gold price data of as long back as you want and keep adding 2.5% every year. That gives you the return provided by sovereign gold bond scheme. Had it been launched in the past? So had this been launched in say 1970, what would have been the return profile? Take the price performance of gold from 1970 and keep adding 2.5% interest every year. So you will get synthetic returns for sovereign gold bond scheme. Now we did exactly that and we plotted this on a graph. So what do we see here? See, if you see this light orange line, this actually represents the sovereign gold bond, and then the orange one represents the performance of actual physical gold, and the green one is your gold ETF, gold bees. So if you see this, the sovereign gold bond has been the best performer. Obviously it will be, right, because it offers you 2.5% interest on top of the price of gold, and then physical gold, and actually ETFs comes the last. Like, this is the worst. This is really surprising, right? Now this brings us to the end of this discussion, but before I leave, I want to answer a very important question. That's, who should buy this? Like, who should invest in sovereign gold bond? See, you should invest in a sovereign gold bond only and only if you are planning to buy physical gold or a gold ETF. Otherwise, you should not go for gold bond scheme. Equities have delivered really much better returns in decades compared to gold. So who should buy this? Suppose if you have a child and you're planning for his or her marriage, and say you want to buy gold after 10 years. Instead of buying gold, you can just buy a gold bond, sovereign gold bond, and it will give you the 2.5% interest over and above the returns from gold. And after 10 years, you may redeem it and then take the cash and buy gold and give it to your child. So in that case, this makes sense. This actually makes sense, and it's a good instrument to invest in gold. So that's it. That's the end of the discussion today. I hope you enjoyed it. So this brings us to the end of the Bond Baba series as well. We discussed a lot of things in this series. We discussed types of bonds, we discussed introduction to bonds, we discussed interest rate futures, and so many things. Make sure you watch the entire series, and I hope if you have seen the entire series, it did help you. We worked really hard on this, and please show us your support by subscribing to our YouTube channel. Share this video. Follow me on Twitter. I am at Astute Aditya on Twitter. You can follow us on, you can follow the official Capitalmind handle on Twitter, which is Capitalmind_in. And please subscribe to our YouTube channel. We'll be back with more content. Till then, see you.